for your patience. We're having a little bit of technical difficulties this evening. My name is Joe Massey. I'm with Castle & Cook Mortgage, and I'm joined this evening by Nick Elder from Ironton Capital. However, Nick is having a little bit of trouble, and we've all had the Zoom experiences and webinar experiences where your mic doesn't work. So he is going to be restarting his computer and hopefully joining us back here in a moment. But I'm going to go ahead and get things started for us. If I could, the chat bar is open. If I could get 1 or 2 or 3 people to chat that you can hear me, you can see me, and you can see my screen, I would really be grateful for that feedback. That way I know you guys are getting all of this information. All right, can see and hear me. And can I get somebody to confirm you can see my screen? Tom said all good. I just want to be 100% sure you guys can see that. Yes, Paul. Okay, thank you. Well, guys, what we're going to be talking about tonight is our national trends update. And this is all information that we have updated as of just about 3 days ago. So this is all updated current information, and we're going to be talking about national real estate trends. Now, the chat bar is open. So as we're going along, I will be sort of keeping an eye on that out of the side of my, the corner of my eye. So if you have questions, type them in as we go along. We'll go through this information at a relatively quick pace. But again, I want you guys to stop me anytime we want more additional details. And Nick, I believe you got at least access to the chat, so you'll keep an eye on that as well. So let's go ahead and get started. Who is Your Castle Real Estate? Many of you know Lon Welsh founded Your Castle Real Estate back in 2004, and recently he sold that company to Cairn Real Estate, and they are partners with JPAR and Your Castle Real Estate, and then Ironton Capital is the capital fund that Lon Welsh started about 2 years ago. And the investment team consists of Lon Welsh. He's the founder, managing partner, has a fantastic background from Deloitte, Accenture, 20 plus years of commercial real estate acquisition and development. And as I mentioned, he was the founder of Your Castle Real Estate. And Vital, he is one of our general partners, really an outstanding guy, just an absolute expert in investment banking, commercial real estate, rental properties, owns and manages more than 80 rental properties, and has a PhD from Carnegie Mellon. So very, very experienced and highly intelligent guy. We're really grateful to have him on our team. And Brent Geyer is our other general partner, portfolio manager. He has more than 20 years of real estate acquisition, development, and land use across multiple states, with more than 15 years owning his own real estate portfolio. So outstanding team that is backing us up here at Ironton Capital. So what are the summary points for second quarter that we just wrapped up about 15 days ago? So number one, housing is normalizing after 2 unprecedented, what we call unicorn years. These were the years that rates were 2-3%. Everybody was buying, everybody was selling, and it is now getting back to a normal market. So we're seeing that prices are up a little bit in 23 and through the first half of 2024, but buyers are slowing down. Why is that happening? Because of interest rates, and we're going to talk about that. Now, we are seeing more sellers think that now is the time to sell, meaning we are seeing inventory building and we are getting to less and less of a seller's market. And rates have improved. We were up to as much as 8% at the end of 23 and early 24. We're now down below 7 as of today, right around 6.7, 6.8%, depending on the day. But affordability remains the primary challenge for new buyers. And we expect that prices could be flat in the second half of 2024. And for real estate agents that are on the phone call, transaction volume is certainly going to be down. We are seeing fewer people moving right now. New construction is going really well with more options for buyers, and they're also willing to take contingent offers. So if you're a seller, and homeowners that are ready to move are really in a solid position. I think that is a very, very important point. And mortgage rates, I get this question every single day. Joe, when do you think rates are going to go down? You know what? Don't expect a huge decline. There's a lot of talk about what the Federal Reserve is going to do, what's going to happen with the election. Don't be surprised if we end up 6 months from now and rates are still 6.5, 6.7, 7%. There's a lot of talk that interest rates may go down, but there's a lot of talk that interest rates may stay the same. And I always make one guarantee about interest rates: they will change. So that's the one guarantee you're going to get tonight, is interest rates will change. Now, if you're a first-time home buyer, what do you do? Number one, buy as soon as possible. Reason being is you can negotiate on the price only one time but you can renegotiate that interest rate as many times as you want. In fact, you can refi whenever interest rates go down. If you work with me here at Castle & Cook Mortgage, we actually offer a free 1-year buy down. So if your interest rate today is 6.8%, for the first year, we're going to give you an interest rate of 5.8%. You're also going to get a free refinance voucher, meaning that you can refinance at any point in the next 30 years with no closing costs. Now, if you're a trade-up buyer, you already own a home and you're thinking about trading up, if you've got a nice house, go ahead and buy now and trade up. The reason being the exact same reasons here. You want to take advantage before prices begin to go up at a faster rate. But you do want to make sure that your home is parade ready. You want to make sure it's all set, ready to go. You've completed any deferred maintenance, you price it appropriately, and really have that property ready to sell. Now, if you're a seller and you're not buying anything, you probably want to wait. Reason being, there is more inventory right now than there has been in the past 24 months. So inventory is at a peak right now and may continue to increase. So if you don't need to buy something and you're a seller, you might think about just sitting tight and waiting for interest rates to go down. When interest rates go down, demand is going to increase and your market power is going to increase. Now, if you're a trade-up buyer with a below average house, you want to wait. All right. Subpar homes are not going to sell easily in this market. Buyers are very, very fussy because of high taxes, high HOA, high insurance, high interest rates. Buyers are kind of picky right now. So if you've got a below average home, you probably want to wait. And then when rates drop, competition is going to make it much easier to sell. Now, if you're an investor buyer, I say this all the time, and everybody hates this: buy now. Look for detached single family homes. I understand cash flow may be a challenge. I understand investment property interest rates are 7.3, 7.4, 7.5. You may have to put a larger down payment in order to get that property to cash flow. But if you buy it now, when interest rates go down, prices are going to go up. You're going to be the beneficiary of all that equity growth. And guess what? You can refinance later, again, using our free refinance coupon. And if you're a trade-up investor buyer doing a 1031 exchange, same thing. Buy now, look for detached single families, and then refi at some point in the future. So let's talk about all of these topics. We're going to start with elections and real estate. So this is really important. Elections do not have a long-term impact on home sales. It mostly slows down sales counts in November, and the delayed sales are recovered over the next couple of months. So we've got a couple of quotes here, but really this one, usually home sales are unchanged compared to a non-election year, with the exception being November. In an election year, November is slower than normal. So what does that mean? If you're a buyer, you might want to wait till November. November could be a really good time to get a deal. If you're a seller, sell your property before November, because things will be slower in November, as a lot of people are glued to their television and glued to political news to see what's going to happen in the coming 4 years. Now, that seasonal drop in November is greater than average. In non-presidential elections, seasonality, as we see sales go down 9.8%. In presidential election years over the last 50 years, we see those sales decrease 15%. So again, if you're a seller, you don't want to be selling right here in November. What would that be? 4 months from now. You want to sell before that. If you're a buyer, I still think it's a great time to buy right now, but you may get some competitive purchasing power in November. And you see that home sales go up after 9 of the last elections. And I think that's going to be true this year. You know, we're in, what year is it? 2024, and we're having a pretty slow year nationwide for transaction count. And I do think we're going to see more transactions next year. But I don't necessarily think that's driven by the election. I think it's just driven by the fact that a lot of people are sitting on the sidelines and sitting on their hands right now. So I think next year will be a continued return to a normal real estate market. Now, the other important point is what happens to home prices. All right. An election year does not alter the price trend that is already happening in the market. So if you look back here at 2008, what was happening to home prices? They were going down. What happened in 2009? Continued down. Same thing here. New homes. What was happening to prices in 2008? They were going down. 2009 continued to go down. Outside of that, over the last 40 years, you've seen that home prices followed the trend prior to the election year or the election year and the year after. So if you're planning for home prices to go down after the election and that's when you're going to get a deal, probably not very likely that that's going to happen. Now, what happens with interest rates? My favorite topic. All right. From July to November, interest rates decreased leading up to 8 of the last 11 presidential elections. Now, you see sometimes in 1984, they decreased a lot. 96 decreased a lot. But for the most part, 0.3%, 0.4, 0.2%, not any huge changes. All right. And I think 80 and 84, you might even throw those out because interest rates were really, really high at that time. You see 14, 13%. So in modern times, if we go back to 2000, you see that interest rates generally go down a little bit as you're leading up to the election. Now, buyer agency commissions. This is a really, really big one, especially for real estate agents on the call. Consumer research shows that commissions might not change a whole lot in the near term. All right. This is one of my favorite quotes here. I'm 3 decades into this business. This is a once in a lifetime opportunity. No different than when you look back over the history of all great businesses. Most of them started during recessions, depressions, or moments of change. This is not a recession or depression, but it is a moment of change. That's from Tom Ferry. And I agree with that. The folks that I see that are doing really, really well right now are embracing the change, embracing the challenges, learning how to adapt to the market and continue moving forward. So consumer research said, which of the following statements do you agree with? When you buy a home, you should definitely have someone who represents your interests during the whole process. 76% of people said, yes, I should have a real estate agent. Buying a home is something you can do mostly on your own, perhaps with just a lawyer to help with the paperwork. 24% of people said yes to that. So between those two, 0.75% of Americans think that they should work with a real estate agent. So even with the commission changes, if you're a real estate agent on the call, I think there's still a lot of upside to that profession. There's still a lot of folks, 76% of Americans, that think they should work with you when they're buying or selling a home. And how do consumers view the home buying process? 91% said it would be very stressful to navigate the home buying process without a real estate broker. And guys, I talk to buyers every single day, and 97% of my buyers are represented by a real estate agent, and they are all stressed out. All right. 100% of the people I work with are stressed because buying a home is a big decision. And this mirrors that. 91% of people say it would be very stressful to do that without a real estate agent. And 87% of people believe a real estate agent or broker is an essential, trusted advisor for a home buyer. Now, the awareness of the NAR settlement is relatively low. All right. Only 37% of people polled realize that there's proposed changes to the real estate industry. All right. And these are people that have bought and sold homes in the past 5 years. They're experienced, vetted real estate consumers with a stake in the game. 63% of them have not even heard about the settlement. That is kind of a remarkable number. So if you're a real estate agent on the call, you need to be prepared to have these conversations with your buyers. Have you ever negotiated a commission with a real estate agent? 70% of people said no. And then, will the NAR settlement impact whether you will use a real estate agent to sell a home? 49% of people said no. 9% of people said, I am much less likely and I'm just going to try it for sale by owner. I believe personally, in the future, these people are going to find that that's still really, really difficult, and they're still going to use real estate agents. So, which statement best represents your opinion about the issue in the trial and the trial outcome? Real estate agents who work with buyers will now have to negotiate how they're compensated directly with those buyer clients, and this makes sense to me. So I think this is a really important reminder that from this NAR settlement, you can still earn a buyer's commission. You can still have that commission paid by the seller. You can still have that commission paid by the buyer, but it does change the calculus a little bit of how you're going to negotiate that into the deal. If the seller's already offering to pay that commission, fantastic. It's just like normal. Now you have to follow the paperwork steps, which we've covered in a lot of other phone calls, but outside of that, you're going to be paid from the selling side of the transaction, just like you always have been in the past. However, if that seller is not offering a commission, you need to have open and honest conversations with the buyer so that you can build that in either by the buyer paying it, by asking the seller to pay it in the contract or some other mechanism to make sure you get compensated for your services. Because one thing I've learned is real estate is a lot more fun when you get paid. So make sure you're following your paperwork. Make sure you're going to one of our trainings on this. Now, 76% of people agree it is worth paying a real estate agent to help you buy a home because it is a big, complex purchase requiring the expert guidance of a professional. And 24% of people said, hey, an agent is not necessary. So I think for real estate agents on the call, there's still a lot of people that need and value your services. And if you were selling right now, which of the following statements would make more sense to you? And this is where we're going to see a little bit of confusion. All right. And this is split almost right down the middle. You should not offer to compensate the agent who represents a buyer because that agent should get paid directly by their own client. Or you may want to because it motivates more agents to find a qualified buyer. So I think we're going to see some of this. We're going to see, 50-50, 50-50 for what sellers decide to do. So if you're a real estate agent on the call, make sure you're prepared to have those conversations with your buyers because you want to make sure when you get to the closing table, you are getting paid. Now, if you were hiring a real estate agent to help you buy a home right now, which of the following payment options would you be most likely to choose? 14% of people said I would pay an hourly rate of $100. 20% of people said I would pay a flat fee of $10,000. 66% of people said I would pay a fee equal to 2.5% of the purchase price with no fee payable if I eventually decide not to buy. And this is the way many transactions work right now, is a success fee. And it seems like 66% of consumers want to continue with that success fee. Now, let's talk a little bit about consumer confidence. How am I doing on time? Oh, good. So the University of Michigan does a study every month to determine how high or how likely are people to buy. What are the conditions for buying homes? And if you look over here, the conditions right now in consumer confidence are as bad as they've ever been. This is a function of high prices, high interest rates, high insurance, high taxes, and high HOA. But guess what? Owning a home still makes a ton of sense. Everybody on this call is probably already a homeowner and probably already owns some investment properties. And you know that that is a great way to build wealth by owning real estate over the long term. And this is where these two diverge a little bit. What do consumers think the change in home values will be during the next 5 years? So check this out. Even last year, a really tough year, consumers think that home prices are going to continue to go up 3.5% to 4% per year. So think about that for a minute. They think it's a bad time to buy, but they agree that prices are going to continue to go up. That's where for real estate agents on the call, it's really important to share this with your buyers, and especially first-time buyers who think it's a bad time to buy. It's maybe not as good of a time to buy as it was back here, but it's still a very, very good time to buy because you're going to get that long-term appreciation and growth of the property. Now, inflation expectations are improving and the change in the financial situation is improving. People are expecting over here inflation to be coming down. And we are seeing consumer sentiment improving significantly. If you look over here, consumer sentiment at the end of 2023 was the worst it has ever been. All right, over the last 60 years that this has been tracked. Well, now where are we at? Consumer sentiment is improving. Now, how many people think that home prices are going to go down in the next 12 months? This was a home buying sentiment survey completed by Fannie Mae. And if you see right here at the beginning of the pandemic, everybody thought that home prices were going to go down. Lenders did, real estate agents, home buyers, home sellers. And then what happened? We got through that pandemic, or we were going through the pandemic. We don't see that home prices are going to go down. Then we get really low interest rates, lots of economic stimulus. Interest rates start going up. What happens? Everybody says, holy cow, we're going to have another crash just like 2008. What really happened? We did not have a crash, and there is only 18% of people that think that home prices are going to go down in the next 12 months. And I'm down here at like 1%. I don't think home prices are going to go down anytime in the near future. We simply do not have enough inventory, which we're going to touch on here in the future. But the important point about this is your buyers and your sellers may be thinking here or here. right? And you want to have this conversation with them and understand their mentality and what do they think is going to happen in the future. Now, consumers are more confident and they think home prices are going to increase. Unfortunately, this has not translated to an increase in purchase intent. And that is because of high mortgage rates are still likely the root cause. All right. Fannie Mae home purchase sentiment is a gauge of how good buyers feel about the housing market, and it fell to its lowest number since the agency began measuring it in 2010, right here. Okay. Just 14% of consumers surveyed said it was a good time to buy a home, down from 20% in April. Those who said it was a bad time to buy a home increased to 86%. But is that really true? All right. So all of these folks here in 2023 said bad time to buy a home, don't want to. Well, a lot of those same folks, let's go back here and look. Oh, this doesn't go back to 2010, but a lot of folks in 2010 said the same thing. Oh, we're coming off of a housing crisis, bad time to buy a home. So if I'm a renter in 2010, my average net worth was $5,400. And if I did not buy a property and waited until 2022, what happened to my net worth? It doubled. It went to $10,400. But if I did buy a property back here in 2010, the net worth of a property owner at that time was $187,000. What happens if I would have bought that home in 2010 and held it until 2022? My net worth is now $396,000. So my net worth doubled just like it did for the tenant. But guess what? Doubling 5,400 to 10,400, that's only $5,000 increase. Doubling $187,000 to $396,000, that is a serious $200,000 increase in my net worth by doing what I was going to do anyways, which is living in a property, whether I'm renting it or whether I'm owning it. So while a lot of people think it's a bad time to buy a home, I think you're going to be really challenged to find somebody who says, hey, I bought a home, I held it for 10 years, and it was the worst decision I ever made. Just about everyone I've ever spoken to says buying real estate, regardless of the time of the market, is a great thing to do if you're planning to hold it for the long term. Now, most Americans still pick real estate as the best long-term investment. So 36% say real estate, 22% say stocks, mutual funds, 18% say gold. My favorite over here, this is new, 3% of people say cryptocurrency is the best investment. So by and large, everyone agrees. Most people agree real estate is still a really, really great investment. Now, most homeowners and renters agree on the many financial and emotional benefits of home ownership and said the idea of owning a home brings emotional fulfillment rather than added stress. Now, are prices going to drop? Actually, let me pause. I need to take a drink of water. What questions does anybody have? And Nick, did you get your mic working? Are you back with us?
Is it working now? Can you hear me? Nothing?
No, sir. Can't hear you, but that's all right. You look great. All right. Anybody have any questions you want to type into the chat? Go ahead. We're going to keep going here on are prices going to drop? So recently, oh, you guys can hear Nick and I can't?
Might be your.
All right. Well,
Might
I'm
be
glad
your.
somebody can hear Nick. So that's a me issue.
Oh,
sorry, Nick. All this
you had me
time I've
going.
been
You
hassling
had me
you.
going. You had me going crazy over here. I was wondering what was going on.
Maybe it was me.
Looks like everybody can hear me.
I don't know. I'm not going to change anything now. Now say something, Nick.
Perfect. Can you hear me now, Joe?
Gotcha. See?
You got me?
Yeah, now I got you. We had all sorts of issues there. That was apparently on me. So, Nick, anything to add on all of that before we talk about prices going down?
I don't think so. The one thing I always like to see is that slide that shows the wealth gap between a renter and a homeowner. Like you had mentioned, it was an important point. Sure, the net worth doubled, but take a look at the volume of net worth that was gained from a homeowner. I think we'll say this, and this is the general consensus at Ironton Capital and what I hear across the board. Warren Buffett says it all the time. Usually, when there's blood in the streets, that's when it's time to act, and that's when it's time to invest. And there's a lot of fear right now, and I think this chart is very important for future first-time home buyers, future homeowners to really get a grasp on and understand. We're at a time period where there's very high interest rates. It's going to be a really good time. There's good opportunities for first-time home buyers and owners. So if you can get into the market while we're in this position of high interest rates, I think you'll be very very blessed that you did in about 2 to 3 years when the interest rates do eventually start to come down. So that's all I wanted to add. Otherwise, Joe, you're doing an awesome job. I'm happy to chime in as we go along.
Cool. Thank you. Thank you. And I'm glad
Yep.
we got the audio issues figured out.
Yep.
So there was a question, is the email deck going to be sent out to you? The answer is yes. You will get an email tomorrow morning that will have a copy of all of these slides. All right. Other questions, go ahead and put those in the chat. Are prices going to go down? So this is the year over year price change. All right. And if you look back here, these are the unicorn years, 21, 22. We saw 17, 18, 19, 20, 21% increases in prices. And a lot of people said, I'm going to wait. I'm going to wait for prices to go down. Well, what happened? Appreciation slowed. This is not prices going down. This is appreciation slowing. And we had about 2 months where prices went down. That was right at the end of 2023 when interest rates were close to 8%. What has happened to prices since? They're going up. So if you're working with any buyers that say, hey, I'm going to wait for prices to go down, already did. You missed the boat.
Mhm.
Now, prices have been really stable in Colorado over the last 12 months, even again, increasing 3-4%. But think about what has happened since 1991. Colorado is in the top 3 of appreciation over the last 33 years. So we've gained 569%. Even if prices were to go down 5%, can you afford to give back 5% of 569%? You probably can. Now, inventory is growing. All right. Inventory is growing across most of the United States, 39% increase here. And this could result in a softer appreciation, which is what we're seeing right now. All right. But we're seeing the inventory still off 38% versus the pre-COVID years. So when we talk about return to normal, we're getting there, but it's still a seller's market. Now, the other important point is to look at how much is the population changing. So the green areas, the dark green areas, when people are moving in, that's one of the things that causes an increase in prices because home builders can't keep up generally with population increases. And you see right here, Denver metro area, lots of green around there. I think Elbert County has just a little bit of loss, but lots of green in the metro area. We are still seeing prices going up, not as rapidly as they did during the unicorn years, but still increasing. Now, what's going to happen in the future? So Fannie Mae, big national conglomerate of mortgage lenders, says 4.8% appreciation over the next 12 months. MBA, the Mortgage Bankers Association, 4.3%. Goldman Sachs, very smart people there, 3.8%. NAR and Zillow. This is interesting. They're predicting much lower appreciation. I think that is a little bit of a bias because they're seeing a lot lower transaction count. Over all of these folks, 2.8% average over the next 12 months. Nick, what do you want to say about this? I got to pause just for just a moment.
Yeah, so let's definitely, first of all, quote unquote experts, right? A couple years ago, experts were saying that the real estate market was going to go down by this same percentage, but negative, right? So I'd say take this with a grain of salt. Of course, we consider them the experts. I think it may be somewhat in line, especially in maybe about 2 years when supply dries up even further. And that's especially the case on the apartment side or on the commercial side. So, I think it'll be interesting to see. I think 2.8 is a pretty fair assessment. We were about 3.3
Yep.
until June of this year. So I think the average of about 3% is a fair assessment. So it'll be exciting to see what happens over the course of the remainder of the year.
I think so too. So debt to income, this is an affordability challenge. Homes were the most affordable back in 2021 and are the least affordable right now. So affordability is the challenge that is slowing down home appreciation and transaction count. And we're seeing that in home prices increasing much faster than household income. And this goes back a long time. And so you might see prices flatten as it takes time for household income to increase. And again, affordability, big thing we always talk about. Now, we see that affordability in other countries is magnified, but we're going to keep going here. We talked about appreciation skyrocketing. And why are prices not declining? There is a severe lack of inventory. Inventory really fell off a cliff through the COVID years. It is increasing a little bit, but not up to even close to where we were at pre-COVID. This was the last pre-COVID year, and we're still down, what, 30%, 35%? That means prices are going to continue going up. Now, compared to other economies, this is just kind of a fun chart. We are negative in building homes to keep up with population demand. If you look at Poland, they're building a ton of homes. This is not something that's really actionable, but just kind of a fun chart to show prices are going to keep going like that. And millennials, there's a lot of pent-up demand from millennials. If you look at where they're at compared to other demographic groups or demographic cohorts, they're behind. And this is a lot of pent-up demand. As they catch up, home prices are going to go up. And then again, that millennial generation is the largest group of home buyers that has ever occurred. And those folks are behind right here. They're going to push up prices as they're entering and participating in their peak home buying years. Now, is there going to be a foreclosure boom like there was in 2007? This is a lending standard guideline here, or a matrix. It is more difficult to get a loan right now than it has been at any point in the past, which is compounded by interest rates, insurance, taxes, HOA, and high prices. It is more difficult to get a home right now as a first-time home buyer than it has been over a long period of time. Well, guess what? If you are able to qualify, you're very likely to make the payment. And if you're very likely to make the payment, not very likely to go into foreclosure. And will the number of foreclosures go up? The leading indicator is delinquencies. And I want to show you guys this. We have less than 0.5% of delinquency in the current market. That is the lowest it's been, since 1982. When there's really low delinquencies, that means everybody's paying their mortgages and everybody is going to continue paying their mortgages. And homeowners are sitting on a record amount of equity. So if you do have somebody who's here and they fall behind on their mortgage, guess what they're going to do? They're going to call one of the real estate agents on this call and say, hey, can you help me sell my house? All right. So it's really important to understand not going to be a ton of foreclosures when there's a lot of equity. That's what leads to a lot of foreclosures, is people being upside down. And the number of homes that do not have a mortgage, we are approaching nearly 40%. 38% of homes do not have a mortgage. So there's 38% of homes that cannot be foreclosed upon. That leads to really, really low foreclosures. My favorite, are mortgage rates going to go up or going to go down? So market expectations are much lower than they were beginning at the beginning of the year. A lot of people expected there would be 6 interest rate cuts. That is now revised to 1.5 cuts today. And in commercial, we're seeing that rates have not changed that much in the last month. But residential mortgages, rates continue to be really volatile. We see up here, we were at greater than 8% at the end of 2023. And we've come down now to about 6.8%. But this is the highest it's been anytime over the past 10 years. And that is what's leading to a lot of buyers sitting on the fence. Okay. Yet interest rates are still historically quite attractive, right at 6.8% as of today, which is below that 50-year average of 7.7%. And the interest rates are less relevant than they were in the past years, as we're seeing more people purchasing with cash. There's a record amount of down payments and a record amount of cash purchases, out just shy of where we were at coming out of the Great Recession. We did see a lot of cash purchases by investors, but we're getting back to approaching that same level.
Joe, quick question for you on that. So we've got the buyers, I think there's 2 spectrums, but we don't hear a lot of what's going on in the middle. We see a lot of the first-time home buyers that might put 3 to 5% down. And then on the complete opposite end of the spectrum, we've got the all cash buyers. You see this every single day, but what about a lot of the folks in the middle? What do you typically see as a leverage percentage? Are you seeing some buyers put down more than 50%, 70%? Do you see a lot of that, or is it typically
rare?
The 2 opposite ends of the spectrum? Okay.
Yeah, very rare. So I do track that. Our average down payment is 18%. And that I've tracked that for 100 years, I don't know, 20 years really. Our average down payment is 20%. I'm sorry, our average down payment is 18%, and that
Mhm.
has not moved in any significant amount over the past 12
Okay.
to 24 months. Nope.
Good to know. Good to
Yeah.
know.
Yep. Good question. Now, experts expect that rates would decline in 2024. However, their track record is abysmally bad. So if you look at from June 1st of 2023, everybody predicted that by now we'd be at rates of 5.5. And then they said, in January, we need to revise that. We think that rates are going to be at 6.47. And then in July, they said, we think that rates are going to be, right where they're at, 6.83, but they think by next year, maybe down as low as 6.4. So this was what they thought 18 months or 12 months ago. Where are we actually? This is what they think for 12 months from now. I think that is pretty realistic.
Mhm.
Now, what happens to interest rates coming out of a recession? You see that interest rates decline coming out of a recession. Now, there's some debate. Are we in a recession? Are we not in a recession? Um, Depends on what metrics you're looking at. When we do go into a recession, we will see interest rates decline coming out of it, but the average decline is roughly 1% exiting that recession. So if we do have a recession and rates are at 6.8%, best case may go down to like 5.8%. Now, how do increasing rates impact the market? Well, we all know this. The number of closed transactions is down. Outside of the pandemic lockdown, we saw a rapid run up in the number of transactions, and now we are all the way down here seeing the same number of transactions, not even the same, even less than we saw back in 2014, 10 years ago. So high interest rates lead to fewer transactions. And if you're a real estate agent or a mortgage lender on the call, you've probably experienced this. And the number of homes that are falling out of contract is at record highs.
Mhm.
And what we're seeing is inspection issues are finding hidden problems, and cash strapped buyers cannot afford to fix those. So back here during the unicorn years, buyers were just excited to get a home. They would take anything that they could get. Now, where are they at? They really want that home fixed up. They want a new roof. They want a new AC. If there's problems, they're going to go to the next house because there's a lot more inventory right now. And we are seeing loan application volume is at a historic low for this time of year. This is a very busy chart, but this is the number of home applications every single week. And we are seeing that loan applications are lower last week than they have been in this time or any time over the past 10 years. And so if you're a seller, you're probably seeing less traffic coming through your open house. This is why affordability is a real challenge. Now, this one is one that I really like. Everybody that got a home here or got a mortgage in 2020 or 21, they said, hey, I've got this 3% rate. I'm never selling my home. Guess what? Not true. People have to sell because of marriages, births, divorce, job changes, and we're seeing those golden handcuffs that are locking people into their homes begin to free up a little bit. We're also seeing more people up here that have a little bit higher interest rates that in the future will likely become trade up buyers. And people are staying in their homes much longer. We're seeing that people are now staying in their homes as much as 9 to sometimes even as long as 10 years, just exacerbating that lock-in effect. But like I mentioned earlier, low loan application means low showing count. We have fewer showings right now on a monthly basis, roughly 6 showings per home in the month of June, which is a heck of a lot less during the pre-pandemic years and certainly less than the 2022 years when we were getting 20, 25 showings for every single property. And showings are up slightly compared to pre-COVID. So we are seeing a little bit more. And you'll remember what I said earlier, a return to normalcy. I think that's what we're experiencing
Mhm.
right now. What's next for long and short-term rentals? Nick, do you want to talk about this? You're really a good expert on this.
Yeah, absolutely. So, I mean, the short-term rental space, I think, is definitely, I think there's definitely we're seeing a quite a maybe an oversupply on the short-term rental space. What I really like about this chart, I can kind of speak from personal experience. A lot of what Ironton Capital invests in, we invest in a lot of the 50 plus units, right? So there's a ton of them out there. And then you've got everything from the 1 unit, you've got the small multifamily from 2 to 4 units. You've got what I like to kind of say, it's considered large multifamily, but small to medium multifamily at 5 to 24. And then you can get larger from 25 to 49. I think this is really an interesting thing to look at right here. If you're an investor and you're looking to acquire property and you're sitting on cash, or you're looking to scale up, you're looking to 1031. I'm with Ironton Capital. I own my own properties as well. I own a 25 unit in Fayetteville, Arkansas. I really like that space because it's less competitive. There's less buyers. So if you're scaling up and you're wanting to build yourself a portfolio, consider where there's a lot, I think, less buyer activity. And I think there's a lot more opportunity in the unit counts of 2 to 4, 5 to 24, and even 25 to 49 units. So if we work with a lot of investors, they've got 10, 12, 15 single family rental properties. If you love being an active investor and you want to continue to scale your rental portfolio, look at these unit counts. You're going to see more unsophisticated sellers that are going to want to sell their properties. I think there's going to be a lot more opportunity in that space. Once you get to 50 and up units, you start dealing with larger syndication firms, institutional capital who are very sophisticated and they can act quickly. So when I look at this chart, that's generally what I think of when I think of you folks as investors and what you're looking to do and the buyers that you work with.
I completely agree. I think you're
Yeah.
spot on, Nick.
Mm-hmm.
Now, vacancy has recovered. So we are seeing that rental properties are getting rented at a fairly quick pace. If you're in Colorado, there has been a lot of new legislation over the past 12 months, and all of this legislation favors the tenant. So we have a great property manager, Eric Ross, over at EcoSpace Property Management. He is the expert on this stuff. If you are an individual landlord, there are 9 new laws that you have to be aware of, and you have to be making sure that you're following. Not here to tell you what to do. If you like managing your own properties, fantastic. Make sure you're aware of these laws. If it becomes overwhelming, I always encourage reaching out to a property manager. 4 new laws as well this is 2023, 9 new laws, 4 new laws in 2024. And we did a webinar, I think last month, Nick, where we dove into these really in depth, right?
Yep. And if anybody wants to see that and did not get a chance to attend that, please reach out to me. I'm happy to send you the link. We went into full detail on each of these laws with Eric Ross live for an hour, just like we're doing now. So feel free to get in touch with me and I'll send that to you.
Outstanding. All right. There's a lot of enthusiasm for short-term rentals. However, we are seeing that short-term rentals are getting oversaturated. So if you're doing Airbnb or VRBO, you might start seeing lower night counts on your units. And that's really what this is predicting here is there's going to be a lot more units. And when there's more units and less disposable income, as we spoke about with affordability, fewer people are traveling, you're going to see occupancy start going down. And Airbnb growth, or the number of units, is growing. But again, we're not seeing as many units that are being occupied on a regular basis. And once mortgage interest rates come down, it's possible that sellers will perceive it's again a good time to list, and that increase in short-term rental supply could be short-lived. But if you're in good, destination coastal markets, might be a good idea. But if you're in an urban market, you might have losses in your short-term rentals. All right. And overall, there could be pressure on rents for a few years. Apartment construction is roaring along at a 40-year high. That means more choices for renters, likely at lower rents. So just be aware, if you're planning on increasing your rents 10, 20, 30%, that might be a hard pill for renters to swallow. So, Nick, tell us about Ironton Capital and what you can do for us.
Yeah, absolutely. So first of all, everybody, thank you for attending this evening. It's a beautiful night, so appreciate everybody that took the time to listen to what we have to say. So just a real quick thing about Ironton Capital. We work with a lot of investors who want to take a more passive approach to their investing. So we work with many different types of investors. Lately, a lot of folks have been selling their rental properties, and they are taking that capital and they're reinvesting into our funds and utilizing the depreciation that we can pass through in our fund to help them offset their capital gains. And so it's a really good alternative to getting off the 1031 treadmill, as you see right here. So if that is interesting to you or you're curious to learn more about that, I would just suggest getting a hold of me, we can actually present a business case and run an analysis on selling your rental and reinvesting through a couple different fund options that we have. So again, if that's interesting to you and you want to redeploy some equity, put into a more optimal investment vehicle, then I'd be happy to have a conversation and we can go from there. So, and then the second thing there is how to manage a Roth IRA for big tax savings. We've done webinars on this, so we presented a pretty unique and tax saving webinar regarding a traditional to Roth IRA conversion strategy. Again, if you want to learn more about that, feel free to go to irontoncapital.com/more listings. Email me, nick@irontoncapital.com, and we can begin the conversation.
Outstanding. Well, that is everything we wanted to cover, guys. If you have any final questions, go ahead and type them into the chat. I'm going to go ahead and put in the chat my contact information. Nick, if you want to put your information in there, and any questions you guys have, we are always happy to help. Would love to chat with you guys anytime. Really appreciate you guys joining us. Nick, my apologies for all of our technical difficulties.
It's okay. I'll see you next month. We'll be here.
Yeah. We're looking forward to chatting with you guys next month. And thank you all for joining us.
Yep. Thanks, everybody. Have a good night.
Bye now.